Hi. The big news in investment markets is the rapid fall in commodity prices, most notably the oil price. Notwithstanding being up a little bit last night, the oil price is down 40% since June this year, from $110 a barrel to about $70 US a barrel. This has implications for the global economy, both positive and negative, and for the sort of investments in any portfolio. Understanding what's caused this price decline also helps to try and understand how permanent this change might be. So obviously it's a supply issue. The boom in US fracking has brought on additional supply, and most recently OPEC has decided not to cut its own production for the stated reason of not to spook the market. But there are certainly many theories about why OPEC is striving for a lower oil price. The most important member of OPEC, which controls about 30% of the oil supply globally, is Saudi Arabia. Saudi Arabia is, as a cash-rich economy, able to withstand a low oil price much better than many of its competitors. So theories abound that it's partly comfortable to see the oil price at a level that makes new US fracking wells uneconomic, therefore putting pressure on its key competitor, but also that it might be a strategic advantage relative to other competitors like Venezuela and Russia and Iran, with whom it shares a seat at the OPEC table, but with whom it has significant religious differences. So who are the winners and losers from this low oil price? Certainly the big oil producing companies have been sold off heavily, as have related companies like Worley Parsons and others. Who are the winners? Well, anyone who has oil as a key input. So the US economy is the biggest consumer of oil globally. And in addition to some other positive signs from its economy, potentially a sustained low oil price is very positive for the US. As commodity prices fall, the Australian dollar can also be expected to fall. But while we see ourselves with a relatively strong Australian dollar, there's a strong investment argument to continuing to invest in quality US companies. In the domestic setting, companies that themselves have oil as a key input warrant some attention. So companies like Brambles, for example, who transport is one of their key costs. Packaging company Amcor is also one of the companies that has oil as a key cost input. And obviously other transport companies like the airlines, Qantas, for example. I think we'd need to get a bit more comfort around whether this low oil price will be sustained before rushing in to top up portfolios in any of these direct Australian companies, because the Australian economy more generally seems to have significant headwinds. So whether we'll see a sustained low oil price probably depends less on understanding geology and maybe depends a bit more on understanding game theory and geopolitics. But it's certainly worth watching, and we'll be monitoring and keeping you up to date. Thank you.